Hey traders, Raghee here. Happy Thursday, everybody. Welcome to Charts and Coffee. Hope everyone's doing well. All right, let's get to the questions. We've got initial claims that have come out already, and the market's responding. Now, remember, we are in that sort of rabbit hole of good news or more positive news about jobs, inflation, growth being actually negative to the stock market. So when you see a better inflation number, a better jobs number, fewer people out of work, more people have work, the markets are typically going to respond negatively. They're not going to be happy about that. So with that being said, you can see how, it's not a dramatic sell-off at 8:30, but clearly the markets did not rally on that. But I will say it's a pretty muted response as I'm taking a look at this 5-minute chart here on the NAS, 5-minute chart on the S&P. Again, very, very muted in terms of the response. Okay, Dow reacted even less. But remember, the Dow and the Russell are in chop. Right now, the Dow's coming off an overbought resistance area, which we've fatigued and moved a little bit lower from. And remember, the Russell is still quite a few days, quite a few sessions into the oversold bounce that it initiated back on the 19th of July. And it's just sitting around that 50% mark within the range. If you're looking at a choppy market, how do you know you're looking at a choppy market? You see the JT multi-trend is yellow. If you're in a choppy market, throw a 50%, just cut the range in half, okay? And then you'll notice how there's sort of this gravitational pull around that area. And again, remember, in chop, your edge is at the edge. Your advantage is quite literally going to be at the oversold support or the overbought resistance. Okay, so with that being said, that's where we sit today. Non-farm payrolls coming up tomorrow. And let's see. All we have really next is just that dramatic 8:30 reaction. So we'll be keeping a close eye on that. I will typically fade moves like that. A lot of folks have asked, Ron, what do you do for non-farm? I don't guess on what the number is going to be. I will typically look for an opportunity to fade it if I'm going to do anything at all, especially where we have already clear directional bias, like the S&P, like the NASDAQ. So it could be a really nice buying opportunity. All right, kicking it off with my VWAP settings. When do I move the monthly anchored VWAP the last month to the current month? That'll be today, Prabish. I'll re-anchor it today. And is it after? Yeah, I'll usually wait for about 4 or 5 days, because if I do it on the first of the month, there's nothing for the VWAP. There's no numbers to crunch. There's no data to calculate. So I'll usually wait until 4 or 5 trading days into the new month. So thanks for the question. So yeah, that'll be today. That'll be tomorrow. It doesn't have to be just a hard day that you're re-anchoring. But yes, today or tomorrow is going to be the day. And I usually do it on a Thursday. Like today, I'll do it on a Thursday because I'll be in the futures room, and I can re-anchor it as we start the day there. Which, by the way, I'll see you all in the futures room at 10:30 a.m. Eastern. All right. Okay, moving on. So yeah, 4 to 5 days. You got it. Yeah. Thank you. And does HPMR? Hey there, Al. Does HPMR work with the? Oh well, look. Anything that has a historical volatility, anything that has the data that we can crunch, yes, it can. Right. Is it effective? Great question, Al. Fair question. Yes. Is it effective? If I've got the historical data, it is. And the more, and I'll add one more caveat to that. The more 24-hour in nature the market is, in other words, 24-hour nature, meaning I would rather pull the HPMR on the NASDAQ futures than the QQQ. I would rather pull the HPMR on, say, the Euro FX as opposed to the FXE ETF. So the more 24-hour nature we have the data, the better. And yes, if I've got that data, so, I would want to pull that kind of data on, say, the VX futures, right? So yes, absolutely. But those are also where those caveats where they would be, well, again, I guess 24, I'm trying to think, is there anything else that I would warn you about? But no, I would say that's really what you want to focus on. So thanks for the question. All right. Can I take a look? Hey there, Nis. Can I take a look at the IWM? Sure. So this is something that we do in the Sector Secrets Mastery and clearly in the futures room because, we're trading futures. But if we are ever looking at an ETF, 9:30 to 4, right? When you think about ETFs or stocks, remember we're talking 9:30 to 4. That's a very truncated look at overall psychology, isn't it? Just a handful of hours focused on the US financial center. That's incomplete to me. And the reason I say that is because I've spent 20 plus years trading Forex, and you get a really complete look at risk appetite and risk aversion and opinion and order flow when you look at a more 24-hour market. So gain the edge. I'm going to tell you guys, don't tell anybody else. All right. This is our secret. Gain an edge on folks who are looking at SPY, QQQ, DIA, IWM, USO, all TLT, GLD, SLV, any of those ETFs that have a futures, alter ego, if you will. Watch the alter ego. RTY is going to be the way that we will measure anything that we will do in the IWM. Okay. They look almost identical. So you might say, Rog, what's the advantage? You are getting a more, a much more total, much more technical analysis indicator friendly view in the RTY. So what's my opinion of the RTY? I kind of alluded to it earlier. So for those of you that are not familiar with distribution, this is Charles Dow 101, right? This is Charles Dow is probably the touchstone for everything that I do in the markets. Charles Dow is why I look at volume the way I look at it, why I look at intermarket analysis the way I look at it, why we look at the underlying phases or psychologies of the market. And so the phase or psychology that the Russell is in right now is yellow, right? See that lower JT multi? It's yellow. That means that I will look at the trend that preceded. Now, if I squeeze in a little bit more data, you'll see the trend that preceded, boom, the chop. So I'm going to keep with it a certain amount of bullish bias. And then I'm going to look, and thank you, Darvis, right? Thank you, 200 exponential moving average support. I'm going to say that my directional bias, I preferably want to be long the Russell, but from where, right? Timing, the level at which we want to actually engage the market matters. And even more so in chop. Here's your resistance, right? Up in that area. Here's your support down in this area. And then everything else just back and forth, back and forth. Now, if you're a fan of a slow stochastic, if you're a fan of the ready aim fire, which is an incredible indicator, you'll know to process the market as oversold, right? And overbought. It's the same thing a slow stochastic does. In terms of, any kind of oscillator looking at the back and forth within a range. So what we want to do is remember that the middle of the range is sort of no man's land. Flip a coin in the middle of chop. One day you're going to be right. One day you're going to be wrong. One day you're going to be right. You've probably experienced this before. But when you get to the edge, right? In distribution, this is what I've always taught for decades. Once you get to the edge of the distribution, how are you recognizing, identifying the edge? Could be Darvis. It could be moving averages. Like the 200 is a really nice lower edge. It was at the last bounce. It could be just looking at the previous peaks and valleys. It could be a slow stochastic. It could be a ready aim fire. I can look at my V-score, whatever it is. I'm not here to tell you how to identify it. Just make sure you're respecting the underlying market condition. Okay. And that's it. That's the IWM. Until it gets back down in here or until it gets back up in here, I really don't have an advantage. So the last time we put this thing on the watch list was that candle specifically, in terms of that move to the lower edge. And when you step back and look at it this way, it's really pretty obvious, isn't it? It makes a whole lot more sense. So I hope that helped. That's distribution. That is the distribution market trend. All right, next up is, do I think that the NASDAQ will make another all-time high today? I really don't know, my friend. And guess what? Nobody else does either. I would say this, though. First of all, every morning, and I've done this for 3+ decades, I sit down in front of my desk and I think, I don't know what the markets are going to do today. Think of it this way. You're a big league batter. You're at the plate. Do you know what the pitcher is going to throw? You've got some tendencies, right? You might know this. You might know this pitcher. You might know some of their tendencies. You might know what they might do when there's a certain pitch count. You might know what they do based on the score and who's on base. You can make some educated guesses. You can work the probabilities, right? But we really don't know what that pitcher is going to throw at us. That's the relationship we have in the market as a trader, and the market itself is the pitcher. It's not adversarial per se. I mean, it's a competition, sure, but I'm just waiting to react. So here's the thing. It's my job not to guess what the pitcher is going to do. That's not really going to help me. It's my job to just, as quickly as I can, identify whether that's a pitch I can hit. All right, so enough of the analogy, enough of the metaphor here. I don't know what the NASDAQ is going to throw at me, but I do know this. It's already in an uptrend. So the probability, to your point, of eventual all-time highs is probably higher than not. But then we have to think about who's on base in the situational, scenario that we have right now. Tomorrow's non-farm payroll. Do I suspect that market participants are going to want to stick their necks out in front of such a major event? Probably not, right? So now we're thinking a bit more situationally. We're sitting right at, let's zoom in a little bit more. We're sitting right at the previous high. I don't believe previous highs are just broken at the first shot. I think it's more like a battering ram that's got to, bang away at the giant door before it's able to get through. So I'm going to presume that resistance is going to hold. I'm not going to presume that there's going to be a breakout. So I'm going to presume we're going to exhaust here. Because that's what the market did last time. I'm not saying that we're going to head lower and reverse and turn into a downtrend or even have a more significant pullback. Not at all. All I'm saying is I suspect we will stall and or pull back a little bit. So as far as today goes, situationally, I'd say it's probably unlikely, but who the heck knows? Just remember that we all are just, even if you're an investor, we are all just batters at the plate. And it is our job to recognize whether that pitch is something we can respond to. And if it is, that means it's met some sort of criteria. So I'm always sitting here saying, I don't know where the markets are going to go, but under what criteria will I react? Will I take profit? Will I exit? Will I enter? Right? And I think when you start looking at the markets that way, it will really make a change in the way that you're processing what's happening. And you'll be less dependent on prognosticating, which is quite frankly, over time, impossible to do properly, to kind of have a high percentage of great trades. So that's the way I look at it. I sit down and say, gosh, Rog, I don't know what's going to happen, but I do know what I want to do if this price is reached or if this indicator signals or if, whatever. So I hope that helps. My thought on the SOXL, so I'm going to, I'm going to look at the SMH. So once we start looking at direction, all these 3 X's, make sure you go to the root of what it is. So I'm not going to look at the SOXL per se. I'm going to look at the root, SMH. I'm going to crack open what's in the SMH. And so the question is, it's double green. Yeah, it just went double green. So I don't look at weeklies for trades. I think that is, for me, never gonna, it's categorically, um, for me, nearly irrelevant. So, if the weekly is in an uptrend, that's nice. It's going to be more. So the weekly for me is an investment, longer term, 6 month minimum time horizon time frame. All right. And remember, again, I'm just telling you what I do. The best thing, the most helpful thing I can do is always share things with the best transparency that I can muster, the most conscious competence that I can muster. Tell you what I do. I could care less what a weekly chart is doing for a trade. Right. The price movement ranges are different. The underlying trends are different. Usually weekly charts are going to get you into trades that you are going to have to sit through a whole lot more noise than the daily would have suggested. Your timing is going to usually be pretty bad if you're using the weekly. That's why I stopped using it for trades. For my investment, for my portfolio, for that book, it's invaluable, right? It's invaluable. But there's not a lot of great structure on the SMH on the daily. But to your point, I sure wouldn't want to short it, right? We've just gone back to double green, which means pullbacks are buyable. I love this volume ledge around 260, the double Darvis around 262. Give me a pullback to 262. Give me a pullback to 260, and I am right as rain. The other thing that you probably would like to do in a situation where you have a very fresh trend that has reemerged. Again, I don't want to be short SMH. I just haven't had the kind of structure that would suggest I can be necessarily as confidently trend following as I'd like to be. What we want to then do is really look to see if there are any relative outperformers within the SMH. ASML would be one of them, right? So it's really important to find the relative outperformers within the overall sector, or in this case, it's ETF. So I'm just going through a number of the symbols that are heavily weighted within SMH looking for relative outperformance. So if I've got a stock that has been double green for longer within the SMH, I'm going to be better off playing that individual boat as opposed to the tide. Okay. So hope that helps, Wilkin. Thank you for the question. Do I ever trade SPX as a proxy for the S&P? Shannon, I'll tell you this, as long as you're looking at the ES, go whatever route you'd like. I personally do not. Not that there's anything wrong with it, but I just personally do not. So what I would say, the cost is higher usually in SPX. Commissions are typically higher, but I think there's a tax advantage. I mean, there's pros and cons to ES versus SPY versus SPX. But I don't think there's a right or wrong here. I just don't. Now that we have Monday, Wednesday, Friday expiry on the SPY, one of the things that I do, to your point, is I will play QQQ and SPY Monday, Wednesday, Friday in the sector secrets. Just yesterday, we played QQQ in lieu of, say, NDX or NQ or even MNQ futures. So I don't, but I don't want that to in any way suggest that you can't. You absolutely can. So, pick your flavor. I mean, it's going to be whatever you prioritize as the best aspects of why SPX over SPY or why ES over SPX. Completely up to you. But it's all pretty much even. It's just whatever you prefer, as far as I'm concerned. I don't think, well, let me put it another way. I don't think your success rate is going to be better by having chosen the best one of the four: micro, mini futures, the ETF, or the SPX. I don't think if you say, by going to ES, I'm going to have a much better success ratio. I don't think that's the case. So any one of the four is really, really, I think, effective and fine. And thank you for the question. I appreciate it. Let's see. Next question is, do natural gas inventories like we're getting today have much effect on natty gas? Yeah, I've been buying pullbacks on natty gas for some time. We've been doing this for some time, both in the mastery and in the futures room, just waiting for our next at bat. Probably no. So at this point, a lot of folks are asking me what's going to create the movement lower. It's probably going to be some sort of EIA, Energy Information Administration, news. It's probably going to be something where the EIA is starting to forecast milder than expected winter or more severe or some sort of supply. It's going to be something like that. When I see a market like this, I'm thinking I need the EIA to come out with some sort of, heating degree day downgrade or something. That's what we're going to need. But whatever it may be, it's probably very unlikely going to be inventories. But I love that you're thinking about a catalyst to the pullback. That is awesome. Yeah, love it. So again, just like that, that's it for Charts and Coffee. I will see you all here tomorrow, same time, same station. As always, thank you for being here, looking at some charts, drinking a little coffee, and I will see you all tomorrow. Be good to each other.